Most people think property taxes are simply part of owning a home. You buy the house, pay off the mortgage, and accept that you'll owe the county every year for the rest of your life. But the reality is far more surprising. Across the United States, thousands of homeowners, especially seniors, are legally eligible to reduce, freeze, or even eliminate a significant portion of their property tax bill. The problem isn't that these programs don't exist. The problem is that most people never learn about them until they've already spent years paying more than they legally had to. If you're over 60, approaching retirement, living on Social Security, or simply planning how to stretch your retirement income further, this directly affects you. And even if you're younger, this is information you'll want to understand long before you qualified, because once you see how these programs actually work, you'll understand why this matters more than most people realize. One of the biggest misconceptions surrounding property taxes is that they're the same everywhere and unavoidable. They're not. Property taxes are administered locally, which means every state and often every county has its own exemptions, credits, freezes, and relief programs. Some are automatic, many are not, and that's where countless homeowners quietly lose money every single year. This isn't a brand new government program. In many cases, these exemptions have existed for decades. What's changed is the financial environment around them. Home values have risen dramatically in many parts of the country over the last several years. Inflation has increased everyday living expenses. Insurance premiums have climbed. Utility bills have become more expensive. For retirees living on relatively fixed incomes, every recurring expense now carries much more weight than it did 10 years ago. That's why property taxes deserve more attention than they typically receive. Consider a retiree receiving around $2,400 a month in Social Security benefits. That's roughly $28,800 a year before taxes. If that homeowner pays $4,500 annually in property taxes, nearly 16% of their annual Social Security income disappears before they've purchased groceries, filled prescriptions, or paid utility bills. Now imagine reducing that bill by half, or freezing it before another housing boom pushes assessments even higher. That's not just saving money, that's creating breathing room. The first form of relief, and arguably the most important, is the homestead exemption. Nearly every state offers some version of this benefit for homeowners who live in their property as their primary residence, rather than taxing the entire assessed value of the home. The exemption removes a portion of that value before taxes are calculated. What does that actually mean? Suppose your home is assessed at $300,000, and your state offers a $50,000 homestead exemption. Instead of paying taxes on the full $300,000, you're paying taxes on $250,000. That difference repeats every single year. Many homeowners assume this exemption was automatically applied when they purchased their home. Sometimes it is, many times it isn't. One application completed today could produce savings every year for decades. The second opportunity becomes available once many homeowners reach retirement age. Senior property tax exemptions are available in many states, beginning around age 65. Some states apply income limits. Others simply require age and primary residency. This is where understanding local rules becomes incredibly valuable. Some homeowners mistakenly assume that because they have retirement savings, receive pension income, or own a home that's appreciated significantly, they no longer qualify. In reality, eligibility often depends on criteria that have nothing to do with wealth. And because counties rarely contact homeowners to announce these benefits, thousands simply continue paying the full amount without realizing a second exemption exists. But here's where the conversation becomes even more important. Reducing taxes is valuable. Freezing taxes can be transformational. Many states offer some version of what's known as an assessment freeze or tax ceiling for qualifying seniors. Instead of allowing rapidly increasing property values to continually raise future tax bills, the county locks in either the assessed value or a portion of the tax calculation. After qualification, imagine two neighbors living in identical homes. Both purchased 20 years ago. Both have houses now worth twice what they originally paid. One homeowner filed for the assessment freeze when eligible. The other never knew it existed. Over the next 15 years, those two homeowners could end up paying dramatically different property tax bills despite owning nearly identical homes. This is where compound savings begin working quietly in your favor. Small annual reductions become thousands of dollars over a retirement. But here's the part almost no one talks about. Qualification doesn't guarantee participation. Deadlines matter. Many programs require applications during specific filing periods. Miss those deadlines, and in many jurisdictions, you simply continue paying the higher amount until the following tax year. That's why awareness is often worth more than the exemption itself. Because an exemption you never apply for has zero financial value. There's another category that's even less understood: property tax circuit breaker programs. The name sounds technical, but the concept is surprisingly straightforward. These programs compare your property tax bill to your household income. If property taxes consume too much of your annual income, qualifying homeowners may receive a credit or rebate. Instead of looking only at property value, these programs recognize that affordability depends on income. A retired couple living comfortably on modest retirement income may qualify even if their home has appreciated substantially over the years. This becomes especially important as home prices continue rising faster than retirement incomes in many parts of the country. The next strategy doesn't reduce taxes immediately. Instead, it changes when they're paid. Some states offer property tax deferral programs. Qualified homeowners can postpone paying property taxes until the home is sold or transferred. For retirees who are house-rich but income-limited, this can significantly improve monthly cash flow without forcing the sale of a long-time family home. Of course, deferred taxes eventually become payable, and homeowners should understand how interest, liens, and estate planning interact with these programs before enrolling. But for the right household, the flexibility can make retirement considerably more manageable. This is where most people get caught. They assume every exemption revolves around age. It doesn't. Many states also provide property tax relief for homeowners living with qualifying disabilities. Others offer significant exemptions for disabled veterans and, in certain circumstances, surviving spouses. These benefits often overlap with existing homestead exemptions rather than replacing them. That means multiple forms of relief may be available simultaneously. Again, the challenge isn't usually qualification, it's awareness. At this point, two very different financial paths begin to emerge. The first homeowner treats every annual property tax bill as unavoidable. They never question the assessment. They never review county programs. They assume the government would automatically notify them if they qualified for assistance. Year after year, they pay exactly what's billed. The second homeowner develops a different habit. Once each year, they review their assessment. They confirm every exemption remains active. They monitor state law changes. They appeal assessments when necessary. They ask questions before assuming the answer is no. Neither homeowner is necessarily wealthier. Neither earns dramatically more income, but over 10 or 20 years, the gap between those two approaches quietly becomes substantial. That's one of the most overlooked principles in personal finance. Financial security often isn't created by one massive decision. It's built through dozens of small decisions that compound over decades. Now let's bring this closer to home. If you're approaching retirement within the next 5 years, now is the time to learn your county's exemption rules, not after you retire. If you're already receiving Social Security, review whether your property taxes consume an increasing percentage of your annual income. If you're caring for aging parents, ask whether they've ever applied for senior exemptions or assessment freezes. Many older homeowners simply assume everything has already been handled. Sometimes it has, sometimes it hasn't. If you're under 65, this information still matters. Buying your first home? Understand how the homestead exemption works before closing. Living with a disability? Don't assume age requirements apply to every program. Helping family members manage their finances. Property taxes deserve the same attention as Medicare enrollment, Social Security, claiming strategies, and retirement withdrawal planning, because reducing recurring expenses often creates more financial stability than chasing higher investment returns. So what should you actually do this week? Start by reviewing your latest property tax bill and your county's assessed value. Next, contact your county assessor's office and ask which exemptions currently appear on your property. Then ask whether additional senior, disability, veteran, or income-based programs exist. Review your assessment carefully. If comparable homes nearby appear to have lower assessed values, learn the local appeal process and deadlines. Finally, create a simple annual reminder to revisit these questions every year. Tax laws evolve, eligibility changes, programs expand, and staying informed is often the difference between paying the minimum required by law and paying far more than necessary. One final thought: financial security in retirement isn't built solely by earning higher returns or finding the perfect investment. Sometimes it's built by reducing the expenses that quietly repeat every single year. A smaller recurring bill compounds just as reliably as a growing investment account. The households that remain financially resilient over long retirements are rarely those who make dramatic financial moves every few years. They're usually the households that consistently pay attention to the details others overlook. Property tax exemptions are one of those details. They're not exciting, they're not heavily advertised, but they can have a meaningful impact on retirement cash flow for years to come. So before you pay another property tax bill, ask yourself one simple question: are you paying what you legally owe, or are you paying what you've always assumed you owed? If today's video helped you understand something you hadn't considered before, let us know in the comments where you're watching from and whether you've ever applied for a property tax exemption in your state. Your experience may help another homeowner discover savings they didn't realize were available. And if you enjoy practical, data-driven financial guidance designed to help you make smarter, long-term decisions, consider subscribing so you don't miss future updates.